One of my customers recently approached me and said they sold all their shares for a loss. Charlie Munger has great advice for this. He's the business partner of Warren Buffett at Berkshire Hathaway, a billionaire investor. And he mentioned that getting rich is not about the buying and selling, it's about the waiting. So what does he mean by that? There's really two strategies he's talking about. Number one, when you're investing in the market, you're not going to get rich overnight. You have to let compound interest work for you, but you have to keep investing every month. If you keep doing that over years, that's when the waiting pays off. Compound interest really makes a big difference, and it can seriously build your wealth faster than anything out there. That's why compound interest has been known as the eighth wonder of the world. So number two, this is the second thing he's talking about, which is waiting to attack. What that means is you want the market to go down. I know this is opposite of everything we've been taught, but as Phil Town states, we make money when the market goes up, but we get rich when the market goes down. That means is you want to wait for those times when the market crashes or dips down, put as much capital into the market as you can, and that's when you make the biggest returns. I've seen a lot of people become extremely wealthy during the 2008 recession. They put in a ton of capital, became multimillionaires. Same thing with the COVID dip in 2020. And then in 2022, at that bear market / recession, they put that capital to work, and that's where they made the big returns, because the market, it always corrects. It's just a matter of being patient. So here's one of my favorite case studies, and I'll get into when I sell. So this is Ronald Reed. I've mentioned this case study in the past. He's a janitor who built up a portfolio worth about $8 million. So the question is, how does somebody who's making minimum wage become a multimillionaire? Well, the answer is not in the buying and selling. It's in the buying and then buying more. And that's exactly what he did. So through probably the 60s, I think it was part of the 60s, but it was the 70s, 80s, and 90s. He was buying a lot of boring businesses like Procter & Gamble, JP Morgan Chase, GE, Dow Chemical. He invested every month. It's that discipline to keep investing over and over. Don't worry about the selling moment. It's buying and buying more. And when you do that over time, that's when you truly build your wealth. So here is when I sell stocks, and I do not sell stocks too often. The last stock I sold, this was, I believe it was the end of 2021, I sold Visa and put that capital into Google. The reason is Visa is still a strong stock. If you hold it, that's great. Credit card transaction fees, it's a scalable model. But I was seeing a lot of competition with companies like MasterCard, American Express, and other payment tech platforms out there. And I thought, well, I can continue to make some money with Visa, yes, but I know I can make more money with Google, Alphabet, because there are more revenue streams. And I would argue probably more scalable revenue streams. Advertising is highly scalable. I'm looking at Google, I'm looking at YouTube, and they own a lot of companies. I think Google owns, last time I did a review, I think I said they own close to like 200 other companies. Those are 200 other revenue streams. And some of them have turned into products, but some of them are still individual businesses generating revenue for the company. So to me, it was a superior investment. Anyway, back to when I sell. So when I sell stocks, it really comes down to three specific criteria, and I use Tykr to help me out with this. When a stock in Tykr changes from on sale or watch to overpriced, that's one criteria that's met. Doesn't mean I sell, but it's one criteria. The second criteria is that 4M score needs to be 59 or lower. So if you're not familiar with the 4Ms, here's a breakdown. As investors, we need to look past the numbers and look at the business. I see too many people out there on YouTube. I see analysts on Wall Street, and all they worry about are numbers. They look at that market cap or P/E ratio or whatever cute number they can come up with, and that's where they make their buying and sell decisions. Yeah.
Are you kidding me?
You and I as retail investors, it's not too difficult. We start with the math part of investing. That's that first M, which is pretty much called the margin of safety. It really encompasses the Tykr score and Tykr margin of safety. Then we move on to the meaning. This is super important. How does a business make money? How many different revenue streams does it have? We like businesses that have multiple streams of revenue, because if one stream of revenue is pretty much pulled out, the business can still survive. I see a lot of new tech startups that are looking to go public and they have one revenue stream. That's too much risk. We do not invest in those types of businesses. Again, businesses with multiple revenue streams are the way to go. Then we move on to that third M, which is the moat. How does the business stack up against the competition? And then the final M, that's the management. What is the track record of the CEO? I like to use this analogy. Let's say you're the GM of an American football team. You're looking for a new quarterback. Are you going to look for some kid who plays high school football, or you're looking for some quarterback out there that has won Super Bowls in the past? The answer is pretty obvious. You want to look for a CEO, a leader that has been there, done that. They've built big businesses, they've increased the share price, so on and so forth. So here's the breakdown of the score. A score between 80 and 100 is exactly what we're looking for. We want to have high confidence to invest in the business. Getting between 80 and 100 is pretty difficult. Then we have between 60 and 79. You should have moderate confidence buying the stock. There may be other stocks out there to look at. And a stock that's 59 or lower tells us this: the financials are getting worse. The business model is getting weaker. The business isn't stacking up against the competition any longer. And the CEO is not pulling their weight. If you get a stock that is 59 or lower, that tells us you can sell, but not quite. And then there's the third criteria, which is I only sell stocks for a profit. This relates to Rule 1 investing.
The first rule of Fight Club is you do not talk about Fight Club. The second rule of Fight Club is you do not talk about Fight Club.
No, this is not Fight Club, but it is similar. Rule 1, don't lose money. Rule 2, don't forget Rule 1. So to summarize, when do I sell? I have to meet all three criteria. Number 1, when the stock changes from on sale or watch to overpriced. Number 2, that 4M score is now 59 or lower. And number 3, I'm in the profit. I'm not in the loss. So what happens if a stock changes from on sale or watch to overpriced and that 4M drops below 59? What I will do is I will wait. I've had to do this in the past with different stocks. Sometimes I'll wait a few months, sometimes over a year. It is what it is, but I make sure I don't train a bad habit and start selling stocks for a loss, because once you do it once, you can get into the behavior or the habit to keep doing it over and over. I have the discipline to not lose money in the stock market, so I'll wait it out. What I simply do is I remind myself that all businesses are in business to solve problems. They're selling products and services. It's not like one day they wake up like a ticked off teenager.
No television for a week. What?
We are so serious, guys.
You're high! Are you out of your mind?
Goes in Robert's wall safe.
On!
These are adults we're dealing with. They're getting paid essentially to produce revenue for the company, selling products and services. So I keep that in my mindset and say, hey, this business may not be looking good here. What happens is the market will rise, bring a lot of these stocks with it, even stocks that are not strong businesses. What I'll do at that point is then sell. It's a patient game, but seriously, it works. Okay, if you like this video, hit that like button. If you want to see more videos like it, hit that subscribe button. And if you want to find some awesome stocks you can get started with in the stock market, I welcome you to join Tykr for free.